In this lecture, we'll talk about sunk costs and the post-investment holdup problem. Like many investment contexts, a key idea here is look ahead and reason back. And like the bank in the picture, reason that if you can be held up, you probably at some point will be held up, and so take steps to protect yourself. The main points in this lecture are, first, if you incur sunk costs, you're vulnerable to the post-investment holdup. You should anticipate holdup and choose contracts or organizational forms that minimize the cost of being held up. Once you're in a relationship-specific investment or make a relationship-specific investment, then the parties in that investment are essentially locked into trading with one another and can be held up by their trading partners. So anticipating this is an important step for each party, and each should do whatever they can to create incentives that make these relationship-specific investments profitable and to make trade profitable after those relationship-specific investments have been made. Let's take an example of National Geographic. Many of you are familiar with the iconic National Geographic magazine. If you've ever subscribed to that or known somebody who subscribed to that, it's somewhat less common today to subscribe to it. I had a grandmother who subscribed to it, and many times you go to estate sales and you'll find boxes and boxes of these very high quality, fairly thick, fairly heavy National Geographic magazines. Well, now if you think about sending those through the mail, they're pretty heavy, and so National Geographic has long known that in order to reduce or minimize shipping costs, it makes sense to print those magazines using regional printers that are geographically close to the final destination. Now, printing a high-quality magazine requires one of those regional printers to purchase a particular type of printing press that runs at about $12 million. Once that press is in place, each magazine has an incremental or marginal cost, paper, ink, time, of about $1. Now, the printer, each regional printer, could reasonably anticipate that a contract with National Geographic would lead to about 1 million copies per year, and National Geographic likes to sign 2-year contracts. So about 2 million copies total each of these regional printers could anticipate printing over a 2-year period. They can calculate the break-even cost, and this break-even cost is relevant if a firm is contemplating making a bid to National Geographic to try to gain one of these regional printing jobs. The break-even cost, or the average avoidable cost, would work out over a 2-year period to be $12 million divided by 2 million copies. That's basically the fixed cost of the printing press divided over 2 million copies, plus $1 marginal cost per copy. So that works out to be about $7 per magazine. Think about this though. Once that press is purchased, the cost is sunk and the break-even price changes. Because of this, the magazine, National Geographic, or any magazine, can hold up a printer in this type of situation by renegotiating the terms of the deal. Because the price of the press is unavoidable or sunk, the break-even cost after that $12 million has been incurred actually drops to $1 over the rest of that 2-year period. Because the press has been purchased and because the marginal cost is only $1, the break-even price changes. And again, because of this, the magazine has a natural incentive in some ways to hold up the printer, to try to renegotiate the price of those magazines, knowing that the break-even price is lower. Always remember this business maxim, look ahead and reason back. I think that can help in many situations avoid potential holdup. So how could that avoid putting yourself in a situation where you're vulnerable to holdup? Well, before making any kind of sunk cost investment, ask what you will do if you're held up. What would you do to address the holdup? One possible solution to post-investment holdup is vertical integration. It might be that regional printers are very wary of buying that expensive equipment, and National Geographic realizes that, has a hard time finding regional printers, and just decides to vertically integrate, or they themselves own regional printers. That would be one possible solution. Another possible solution would be to lease the equipment, have a lease arrangement where The regional printer agrees to enter into a contract, but demands that they lease the printing press from National Geographic. Then National Geographic is incurring the $12 million cost, and the regional printer is less vulnerable to the post-investment holdup. Consider a mine and alumina refinery. Refineries are specifically tailored to particular qualities of ore. And the transaction options are, you can either do a spot market transaction where you refine that ore into its finished product and sell it right then. You can lead to, or you can enter into long-term contracts where you agree to produce and sell a certain quantity of the finished material over a particular period of time at a particular price. You can also vertically integrate. Vertical integration refers to the common ownership of two or more separate stages in the vertical supply chain that connects, in this case, raw materials to the finished goods. Vertical integration is a solution to the post-investment holdup problem because in that case, as you move up the production chain, if you have an incentive to do a hold up or hold somebody up, you're only holding yourself up. And so it really eliminates that incentive to hold somebody up lower down in the production chain. It's this common type of ownership, or the common ownership of these multiple levels of production then, that can be a natural solution to the post-investment holdup problem. Thanks for listening.